All right, welcome back to the second part of life insurance module. So in the first part, we talked about what insurance is, what is risk management, and we also talked about, term insurances. So now we want to talk about what if we have permanent needs, or as we can call it, permanent risks. How can we identify when a risk is permanent? That is when there is no end date to when this risk is going to be gone. So let's give some examples. Funeral costs. I know that whenever I die, I'm going to have funeral costs. And I don't know when I'm going to die. And this risk is going to stay with me, right? This expense is going to stay with me until the day I die. But when you compare this to, let's say, a mortgage, we know when the mortgage is going to end. And that is why we need temporary insurance. So that is where the difference comes in place. Or let's say leaving a legacy. If I want to leave something behind for my family whenever I pass away, estate creation, estate taxes. So see, all of these happen when you die and also donations. So for all of these, we need a permanent insurance, a permanent life insurance that is going to cover us for any time that we pass away. There's going to be that coverage to take care of the risk. And when we want to talk about permanent insurances, overall, we have three types of permanent insurances. First, it's called T100 or Term 100. Second, it's a whole life policy. And third, it's a universal life policy. So when we talk about term 100, it's kind of exactly like a term insurance that we had, like a T10, T20, but the difference is that this one is for the rest of your life. So it's not going to expire. But keep in mind that the premiums are only until age 100. So if you turn 101, you don't need to pay premiums anymore, but you are still covered. All right? So this is the most important part of a T100, that it is a permanent policy, it never expires, but the premiums that you pay is only until age 100. But now let's talk about whole life and universal life, as they are basically the most important parts of this module. Regarding whole life insurance, this is one of the insurances that not only provides you with death benefit, but is also with investment or cash value as well. The reason why some life insurances have investments inside them is mainly because we want your investments to grow and cover the cost of insurance. Also, it is another way that you can save money and grow your money tax sheltered, which means that you do not need to pay tax on the growth of your money inside these life insurance policies. If you want to take it out, you do have to pay tax. But as long as it's kept inside the insurance, you don't need to pay tax. So for a lot of people that they have maximized their TFSA, maybe their RSV, and they are looking for another way to invest and grow their money tax sheltered, a life insurance like a whole life policy could be a really good idea. So, the most important definition of whole life insurance and what it makes it stand out from any other type of life insurance is that the premiums are a part of the premiums go into the cost of insurance, and the other part goes to savings to build that investment. But the most important part of life insurance is that we don't know how much of that premium that we pay goes for the cost of insurance and how much of it goes for the saving. So I might be paying, let's say this is how it works. You want to get $500,000 of a whole life insurance, and the company is going to just tell you, hey, it is going to be $200 a month. So you don't know how much of this $200 is going for the cost of insurance and how much it's going for the saving. Basically, what it says is that it's none of your business. You just give me $200 a month, and I will guarantee that you will have this death benefit, and I will guarantee you your cash value as well. So anything could happen in the market, anything could happen in, the economic future of the country, or let's say we're talking about Canada, but they're both guaranteed. So it's none of your business. I will just tell you what you're going to get. All right. So that is the most important specification of a whole life policy. In terms of the premiums, obviously, again, when it tells you it's none of your business, it means that I'm going to guarantee the premiums as well. So you will never need to pay extra in the future. If I tell you right now that you have to pay $200 a month, it is going to stay $200 a month. And regardless of how the investment returns and how the insurance company is going to operate, I am not going to ask for more money. There are some cases that the premiums are adjustable, like every 5 years, but it rarely happens in real life, and it's always guaranteed premiums. And most importantly, is just like the term insurances, whole life insurances have a modal factor as well, which means that if you pay annually, the price is going to be less than paying on a monthly basis. Now, again, regarding the premiums, we have three ways to pay these premiums. The first way is something called a single premium. So you pay a lump sum amount right at the beginning of the policy when you purchase it, and you don't need to pay anything else. But there is another option, which is called ongoing premium. And that means that you have to pay premiums for your entire life. The good thing about whole life insurance is that they also have a third way of paying your premiums, and that is called a limited payment. So a limited payment basically means that you're only going to pay for a limited time, and after that, even though if you're alive, you do not need to pay for your insurance. Basically, and most commonly, I would say, it is a 20-year payment. So in 20 years, you pay the cost of insurance and it's done. So there is no expense for you after 20 years. That is how a limited payment works. So once again, whole life insurance policies, they say it's none of your business. We will guarantee you a death benefit and we will guarantee you a cash value and we will guarantee that your premiums won't change. But you don't need to know what I do with those premiums. It has a modal factor. So if I pay monthly, it's going to be more expensive. And there are three ways that I can pay. A single premium right off the bat. I give a lump sum amount of money. Maybe let's say for $500,000, I might pay $100,000 and I'm insured. It rarely happens. Like in real life, again, insurance companies don't usually provide that option, but it's in the books. We have ongoing premium, which means that you pay for your lifetime, and we have limited payment, which you only pay for a limited time, which is usually 20 years. Now, remember that we talked about the guarantee part of the whole life policy and how the cash value is guaranteed as well? Well, it's really important to understand that there are two main uh, whole life policies. So we have something called a non-participating whole life policy, and we have a participating whole life policy. What is the difference between a non-par or a par whole life? I'm specifically saying par because you are going to see this in the exams. A lot of times they just say par. You have to understand what they mean by par. It means participating. So when we say a non-participating whole life, we mean that this is a guaranteed cash value. So they just pay you the guaranteed cash value, whatever it is in your contract. But in a participating whole life, the reason why they call it participating is because you become a shareholder of the insurance company. Basically, what happens is that you are purchasing shares with the premiums that you are paying of the insurance company that you're signing and getting the insurance from. So when this happens, not only you get the guaranteed cash value, but you also might be eligible to dividends as well. So if those shares make extra profit, right, they will distribute it among the shareholders and you will be eligible to get more money. But remember that this dividend part is not guaranteed. You might make money, which we call it surplus, or maybe the company shares are going to lose profit. So it's going to be a shortfall. And that is the risk that you're going to take. It rarely happens again in real life that dividends are going to be negative, right? Like actually, it can't happen. But what happens is that it might differ in the percentage that they're providing to you. It could be 1%, it could be 3%, it could be 6%. It depends on the company, and you have to see how the company is performing, right? Financially. So let's look at an illustration chart of a whole life policy. Let's say in this example, as you can see, this is a 20-year-old person and has purchased $200,000 of life insurance. The insurance company says that for you to have $200,000 of life insurance, and right now, please only pay attention to this left part. All right. So the life insurance company says for you to have $200,000 of life insurance, I want you to pay 3879.36 a year. And as you can see, the payment stops after year 20. It's going to be zero. So this means that this is a limited payment premium, just as how we talked about it in the previous slide. Now, the cash value here, as you can see, it says guaranteed values. So this cash value is guaranteed. For the first 5 years, they're not going to pay you anything. The cash value is zero. But after that, it's going to guarantee you a $600. And then next year, it's going to turn out to be $1,400. You can see that after 15 years, it's $18,000. And at age 65, you have $113,000, almost 114. So if the client passes away, their family is going to get $200,000. If the client needs some money, they can take it out from this $113,000. This would be a non-participating whole life, which everything is guaranteed. But in this section, it says with the dividend scale, and it's a non-guaranteed value because we don't know in the future how much dividend we're going to be paid. But as you can see, that because of the dividend options and these dividends being added to the cash value is not zero anymore. And it's also making the death benefit grow as well, which we're going to talk about it. But in this case, you would see that after 15 years, there is $35,000 of cash value, or 34, and there's $271,000 of death benefit. Also, at age 65, there's $412,000 of cash value, $750,000 of death benefit. If a client either takes a part of this money out or a part of this money out, it will be deducted from that death benefit. So let's say even in the non-par, if the client takes out $50,000, then the death benefit is $150,000. All right? It's the same thing with the participating whole life as well. So obviously, a participating whole life is going to be more expensive than a non-participating whole life. So although that you see it's the same premium, but keep in mind that because this whole chart is a participating whole life illustration, if it was only going to be solely, a non-par, the premiums would have been less. So this is the difference between a non-participating whole life and a participating whole life insurance. Now, something that I want you guys to pay close attention to is this dividend part. So the company is going to give us dividends. And we have different options of what we want to do with that dividend. The first option is that I could take this money out as cash. So let's say in the first year, when I get $140, I could just cash it out. If I do that, then obviously my cash value is going to exactly look like what it is over here in the guaranteed part because I'm taking out the dividend. So every year when I get my dividends, I could cash it out. Second, it's called premium reduction. So what I'll do is I'll tell the company, okay, I made $140 dividends, deduct that from the $38.79 that I have to pay next year. So I'm going to pay less premiums. Basically, my dividends are going to pay my premiums. Third, we have the accumulation option. It's a side account. What it means is that I'll tell the insurance company to take out this $140 and invest it somewhere else in another account. And fourth, we have a term insurance premium. So again, I go to the insurance company and I say, how much insurance can I get? And it's going to be a T1. It's going to be a 1-year insurance. How much insurance can I get based on my age with $140 premium a year? So I will have more insurance. And then next year, based on the dividends, I will get more insurance. So every year, I will get a little bit of insurance only for a year because I'm only getting a T1 and I'm using my dividends to pay the premiums. So all these four options have something in common, and that is that you're taking the dividend amount and the dividend money out of the policy. If you cash it out, you're taking it out, you're withdrawing it. If you use it for your premiums, again, you're taking it out, you're using it to pay your premiums. Accumulation, you're putting it in an investment account. And also, term insurance means that you're spending it on an insurance. But the one that you actually see here is none of these, because this is the option that the dividend is staying inside the insurance policy. As you can see, the total cash value is growing and also your death benefit. This is what we call a paid up addition dividend option. So a paid up addition is a type of dividend option that the money stays inside the insurance policy And how it works, and we're going to talk a little bit about it further on as well. But how it works is that the you're going to be buying kind of like a whole life insurance inside your whole life. So that is why that you see that the death benefit grows, because with that money, not only you're investing it inside that whole life policy, but it's also giving you life insurance as well, and it's going to be permanent life insurance. So paid up addition is the ideal way if we want to, you know, um, compound our death benefit, our cash value inside the whole life policy. And usually, as an agent, our job is to make sure that we keep the money inside the policy. So I would say 80% of the time, the answer between what dividend option I have to choose is going to be paid up addition, unless in the question it says otherwise. Let's say the client is, basically um, uh, wanting to have more insurance, or a client says that I don't care about cash value and I want to pay less premiums. That's when you choose different options. But overall, the correct answer would usually be paid up addition. So this is what a non-participating whole life is, what a participating whole life is, what are the differences, how are the dividends basically used, and it's important to know that price-wise, still convertible term is the most expensive policy. Why? Because you have a term insurance. Let's say this person is 20 years old and is now buying a $200,000 policy, which is going to cost them 38 to 79 a year. Obviously, if they get a term and they want to convert it at age 30, they have to pay much more. So that is why that overall, apple by apple, if we're comparing, that means the length of the person that's going to stay alive, convertible term is going to cost more. Then it's participating whole life, and after that, it's non-par whole life. T100 obviously is more expensive than T20 because they're transferring more risk. It's a more period of time. Let's look at a couple of questions so we can understand everything better. Um, Honestly speaking, maybe this question is not exactly relevant to the whole life policy, but let's actually look into it. So, which of the following policyholders is least likely to have their insurance contracts canceled after 31 days of missing a scheduled payment? Is it Rick, who has a minimally funded universal life policy? So, a universal life policy, we're going to learn about it right now. It is kind of like a whole life policy, so it has cash value in it, but it's saying that it's minimally funded. So, there might not be that much funds or that much cash value that they can use for the premium. B, it says Gary, who has a 30-year term insurance policy, which he purchased 2 years ago. So this is a term insurance. Even if you've been paying for 2 years, you do not have any cash value. So if you miss the grace period, right, you're over the grace period, the 30 days, and you haven't paid your premiums, your policy is going to be canceled. We have Tina, who has a creditor insurance policy. Again, there's no cash value. So if you don't pay after 30 days, the grace period is over, and obviously the policy will lapse. But Colin, who has a whole life insurance policy with a high cash surrender value. What does cash surrender value mean? It means that if you cancel your policy, that is the amount of money that you're going to get. So after all the deductions of the fees and everything. So in this case, because it is a high cash surrender value, that means that there's a lot of funds inside the whole life policy. And obviously, after 31 days, the insurance company can take a part of that cash value to pay the premiums. So the correct answer over here is D. Let's go into another question, which, um, again, a part of these answers and the options that the choices that you see, we haven't talked about it yet. But what we want to try to say is that um, which one of these does not require additional underwriting? So when you have a lengthy question, it's really important that you first read the last sentence, see what the question wants from you. And that way, you could obviously be reading the question more focused. Because if I have just a glimpse, I would say, okay, there's a $400,000 here, there's $800,000 here, maybe there's some calculations that I need to make. I don't know. But if I just read the last sentence, I could understand what I need to focus on. So in this question, it's saying Jaya is the policyholder. Oh, my apologies. And the life insurer of a $400,000 participating whole life insurance policy. She purchased the policy 3 years ago when she was single. Last year, she got married and is now expecting her first child. She has been paying monthly premiums and wishes to pay the premiums annually from now on. So she wants to pay the premiums annually. She also wants to increase the coverage amount to $800,000 and add a terminal illness rider. We will talk about riders later on. She would like to change the dividend payment option from term insurance to paid up addition. Which of the following amendments does not require underwriting? So if I want to make a change to my policy, it might and probably it will go into another underwriting. If I want to add a terminal illness rider, I'm just going to tell you guys what it is. Basically, what it means is that if the insured is terminally ill and is diagnosed with something that the doctors um, are confident that that the insured is not going to live more than 12 months, the insurance company can actually pay a portion of the life insurance to the insured itself. And for that, because it's a medical thing, obviously it's going to need underwriting. If I want to increase my coverage, again, it's going to need underwriting. If I want to even put a PUA, because the PUA is going to be adding insurance into insurance, right? As I told you guys, it's kind of like buying a whole life insurance inside a whole life insurance. So it's going to need underwriting as well. But changing the frequency of the premium payment is obviously something that doesn't need an underwriting. So the correct answer is D. Let's go with another question. It's basically about modal factor. So it's which premium payments is going to be the most efficient, cost efficient way, which obviously it is annually. All right. So now that we talked about whole life policies, let's go into the universal life insurance. After universal life is done, it is really important that we go through some other, topics as well. But mainly we are finished with the core parts of this module. So what is a universal life insurance policy? As much as we understood about whole life, universal life is exactly the same concept, but with a different intention. Why do I say different intention? Because if you remember, for the whole life insurance, I was saying that it tells you it's none of your business. But over here, universal life insurance policy, it's saying it's none of my business. And they're actually putting everything on your shoulders. So let's talk about the definitions of universal life insurance. First of all, it's customizable. So unlike whole life insurance policies, that when you purchase it, you can't really change it. You can't change the premiums. You can't change the death benefit. If you want to make any changes, it has to go through underwriting, right? And the entire policy is going to change. But over here, when you purchase a universal life policy, and I'm going to show you guys down the road, you can change the premiums. You can make a lot of changes into it. As mentioned right now, again, there's minimum and maximum funded premiums. So you can choose between a range of how much you want to pay. There's no modal factor. So it means that it doesn't matter if you pay annually or if you pay monthly, the price is going to be the same. It's tax sheltered. So again, just like whole life policy, obviously, they are both tax sheltered when you are doing the investments. The cash value is not guaranteed. So if you remember in the whole life policy, either it was a non-par or a par, it still had a guaranteed cash value inside it. But over here, there is no guarantee. You know where and how much your premium goes. Again, in whole life policies, we said we have no idea. The whole life insurance company is going to tell you it's none of your business. But over here, Universal Life is going to say it's none of my business. You do what you want to do. Death benefit can be indexed, so you can increase your death benefit year by year based on a percentage or an amount. So when we're talking about life insurance, and before we go into the premium section, it's really important. Again, it is insurance plus investment, just like what it was for whole life. But the difference is that in whole life insurance, this investment part was done by the insurance company, right? And we didn't know what they're going to do with it. They might be, doing construction, they might be paving highways, they might be opening schools and hospitals, they might be doing some investments in stock market. We don't know, right? But in the universal life policies, these investments are actually in a mutual fund. So when you want to purchase a life insurance, a universal life insurance, you choose based on like any insurance company, they have a couple of mutual funds. You can choose those mutual funds for the investment. So it is your responsibility based on your risk appetite, based on your financial knowledge and your investment knowledge on what mutual funds you're going to choose. And that is why that there's no modal factor and there's minimum and maximum funded premiums. Because you can, if you decide, you can invest more into your mutual fund or invest less. So when I pay the premiums, and obviously we know this, that premium is cost of insurance plus what? Investment, or I want to actually call it ACB. adjusted cost basis. It means the amount that you put in for investment. So in this case, the insurance company is going to say, I'm going to exactly tell you how much is the cost of insurance. Let's say, for instance, they say it's $100 a month. So if I am paying $200 a month of premium, that means $100 is going for the cost of insurance, and I am investing $100 a month inside my mutual funds. I hope that you got this part. So again, it's insurance plus investment. And the investment is in a mutual fund. When you're paying your premiums, premiums are two parts. It's cost of insurance and also ACB, which ACB is the amount that you deposit into your investment. Why is all of this really important? This insurance part in Universal Life acts exactly like a T100. So it's basically buying a term insurance plus mutual fund. But this is where it gets really interesting. There are two ways that you can have this Universal Life structured. Let me ask you guys a question. Is a T100 more expensive or a T20? Obviously, as we've learned, a T100 is going to be more expensive than a T20 because you're transferring a lengthier time of risk to the insurance company. So what about a T10? Which one is more expensive? Obviously, a T20 is more expensive and a T10 is cheaper. I want to ask you guys this question. What about a T1? What if I buy only insurance for 1 year? How is that going to look like? It's going to be super cheap because the risk that I'm transferring to the insurance company is only for 1 year. So, why am I saying this? Because I can choose the way I want my cost of insurance to be calculated in a universal life policy. One option is called the level cost of insurance. So it kind of exactly means that I'm getting a T100. So I say, okay, I want $500,000 of life insurance. The level cost of insurance, if I want to get a T100 on this one, means that I have to pay, let's say, for instance, $200 a month. So now, so this is the cost of insurance. So let's say if I am paying $400 a month, what does that mean? That means that my cost of insurance is $200 a month and my ACB is $200 a month, right? That means $200 a month is going into my mutual fund. But the other way that I could actually pay my insurance is called YRT, a yearly renewable term. It's a T1. So the cost of insurance will increase every year because my age increases every year, right? It's not going to need any medical underwriting because it's a renewable term. And you guys remember from when we studied term insurance, if it's renewable, there's no medical underwriting required and it's only based on your age. What benefit is this going to give me? If I get a T1 renewable, right? And let's say I'm 30 years old, my cost of insurance is not going to be $200 a month anymore. It might actually be only $20 a month, right? Because the risk is only for 1 year and I'm still young. So if I'm still paying $400 a month, what does that mean? Now my ACB is $380. So the amount of money that I'm investing inside my mutual fund is going to be much more. So my mutual fund is going to increase in growth, right? So it's the same premium of $400 a month that I'm paying. The difference is in a level cost of insurance, that cost of insurance is always the same. So my ACB is always going to stay the same as well. But in a T1, my cost of insurance increases every year. It starts really, really low, right? So I have more money that I would put into my investments. And then in the future, when the cost of insurance gets more expensive, right? Let's say at age 60, 70, 80, and the level cost of insurance is still going to stay $200 a month. But in the YRT, it is going to be maybe $800 a month. But my investments, my mutual fund, can pay off that difference. So let's actually look at an example. This is an illustration for insurance, for a universal life insurance policy. As you can see, I've made everything customizable. So number of years of planned premiums, I've chosen it to be 15 years. So a client, an insured, a policy owner, they can choose how many years they want to pay, right? Second, the insurance company is telling me that if you want this amount of life insurance, whatever amount it is, you have to minimum pay $911 a year, and you can go maximum up to $6,500. So that is your bracket of how much you want to invest and how much you want to pay. Also, you choose where you want to do the investments. So based on the mutual funds that the insurance company provides, you can choose what and where you want to pay your premiums and where do you want to invest it. And because this is an illustration and we don't know how the market is going to work, there's an assumed rate of return. for instance, it's 5%. So see, I made a decision that I want to pay $1,000 a year between the 900 and 6,500 that I'm eligible to do. I've decided to pay for 15 years. I've decided where I want to invest, right? Now let's look at the chart. So as you can see, my annual premium is $1,000. I actually made it a little bit more interesting. After 5 years, it turns out to be $1,500 a year. That's how I wanted to make it. So for the first 5 years, I pay $1,000 a year, and then I switch it for the next 5 years to $1,500 a year. And then for the next 5 years until year 15, I have decided to pay $2,000 a year. So it's my choice of how I want to do it, right? So I can make changes to it. As you can see, the annual charges of this policy is increasing. It starts with 407, right? It does get a little bit low here and there, but as you can see, at year 35, it's 963. So this is definitely a YRT, universal life. The cost of insurance is YRT. Why? Because as time goes by, the cost of insurance and the annual charges are increasing. If it was a level cost of insurance, you would have seen the same number all the way down. So I have a fund value again, and then I have what I could actually take out. So this is a cash surrender value, basically, right? And this is a $250,000 of insurance that I have. So again, let's say after 35 years, when I have $45,000 in my account, if I take out, let's say $30,000, then this $30,000 is going to come out of my death benefit. So my death benefit is now going to be 220, right? So if I take out $30,000 out of this $45,000, then it's kind of like I'm taking out $30,000 from my death benefit. So this is how a universal life insurance works. Customizable, no model factor, tax sheltered. You can decide and you can make any changes you want. So now we want to talk about how we can withdraw money from our policies, either if it is a universal life or a whole life policy. Okay. So if I want to take money out of my whole life or universal life policy, if it's a whole life policy, well, let's first go with universal life. It's a universal life policy because I am investing in mutual funds. Mutual funds are capital gains. So I have a 50% of basically tax exempt and 50% of my gain is going to be taxed, right? So how it's going to look like is this. Again, my cash value minus whatever I've put it in, which is the ACB, equals to the capital gain. And I have to pay tax on 50% of it. So whatever the capital gain is, I first take out 50%, and then whatever my tax rate or my MTR is, that is the amount of tax that I'm going to pay. The difference between this, that is for universal life and whole life, is that whole life is not a capital gain. So that, therefore, there is no 50% tax exemption. You pay tax on the entire amount of growth. Okay, so just keep that in mind. For whole life, there is no 50% tax exempt. For universal life, we have the 50% tax exempt. Another thing that you guys can do with your universal life or whole life cash value is that you can assign it as a collateral. So you can go to the bank, you can tell the bank that, hey, I have $100,000 in my universal life or whole life account. I want to get a collateral loan. I'll put this as a collateral and you give me a line of credit. How that works is that you don't actually need to pay it back, that loan, right? And if you die before paying back the loan, what's going to happen is that based on the interest rate that you've got the loan from the bank, you will basically have to pay that loan from your death benefit. So how it works is like this. Whatever the death benefit that you had was minus the loan plus the interest rate, right? That would be my new death benefit. So let's make an example. Let's say if someone had $500,000 of death benefit, all right? And then they had $150,000 of cash value. Also, they take a loan of $100,000, right? After 5 years, they die, and also the interest rate of the loan was 4%. So we want to know what the new death benefit is. So it's really easy. Well, first of all, we have to know, well, we have everything that we know, sorry. So now what we're going to do is we're going to say my new death benefit. I'm first going to see how much the the insured owed to the bank. So it's $100,000, right? Multiply 1 plus the interest rate, which is 4%. I'll write it like this. And then it's going to go to 5 years. Now, it's going to be a really easy task to do. I'm going to show you guys how to do this. So the way that I want you guys to do this is like this. I'm going to bring the calculator here. You're going to write down $100,000 and then multiply. That 1 plus 0.04 is 1.04, right? And then by the amount of years, you click on the equal sign. So it's 5 years. I'll click on it 5 times. 1, 2, 3, 4, 5. There we go. So after 5 years, it is $121,000. Let's say, just to round it up, we're going to say it's $121,000. So the death benefit was 500,000. So 500,000 minus the $121,000, that was the loan plus the interest. What would be the deduction? It would be 379, right? So this is the new death benefit amount that the family is going to get. This is how we calculate the new death benefit if an insured was basically took out a line of credit and used the insurance policy and the cash value as a collateral loan. Now, it's really important that in universal life policies, you could actually, you have two types. You have a type that it's only the face amount. You have a type that is face amount plus the funds. So basically, the beneficiary will get the 500,000 plus the 150. If it's in that case, just keep in mind that this is not going to be 500,000. It's going to be 650,000. So if it says in the question that this client, this insured person, had a universal life policy plus accumulated funds, which means that it was the base plus or the death benefit plus the cash value, then at the end when the client dies, what you do is you add the death benefit and the cash value together. It's going to be 650, and then you deduct 121,000 from that. All right. So that's the most important part. But we don't have this in whole life policy or in a simple death benefit of universal life. If it doesn't say that it's added, like the death benefit and everything is added with the cash value, and it just says that it's a normal universal life policy, then obviously you do what I did here. But otherwise, you have to add the cash value into it as well. Why do people do this? Because you don't want to pay tax. So you do it like this. There is a third option as well, which is called a policy loan. And in a policy loan, you take a loan against your own policy, which is inside the insurance company. So the collateral one, you get it from another third party. But this one, you get it from basically your insurance company. And you have to pay tax on that. So that is a difference. So a policy loan has tax, but collateral loan does not have tax. Now, um, let's do an example for withdrawal of universal life as well. Let's say if the death benefit is $500,000, right? And then cash value is $200,000. Premium is the premium that they've paid, let's say until that time, was $100,000. And the cost of insurance of this policy up to that time is $30,000. So basically, we want to know right now that what is the CV minus ACB so we can calculate the capital gain. If this client decides to cancel their policy, so they want to cash out their $200,000, right? So this is how it's going to work. I know that my premium that the client has paid is $100,000 and the cost of insurance is $30,000. What I need to calculate first is the ACB, which ACB is going to be premium minus cost of insurance. So it's going to be $100,000 minus $30,000, and that is going to be $70,000. So this is my ACB. So this amount of money was invested that now I have $200,000. So I will do $200,000 minus $70,000, sorry. It is going to be $130,000. This is my gain. Okay. So since it's a universal life policy, I have a 50% tax exempt. So I deduct 50% out of it. That's going to be how much? It's going to be $65,000. right? And I have to pay tax on this 65,000. Let's say if my tax rate was 30%. So now I have to pay 30% tax on the $65,000, which is going to be, uh, I think, 19,500. So what that means is that when I get this $200,000, I have to pay almost $20,000 of tax. So what I get is $180,000, basically. Sorry, $180,000. Yes. This is if it's a universal life. If it was a whole life policy, I had to pay tax on the entire $130,000. Okay. So this is how ACB is calculated. This is how we understand how much tax we have to pay if we surrender our policy. All right. Now I want to go a little bit further as well. If the client does not want to surrender the policy, but basically wants to take out $100,000 out of the cash value, what will happen at that time? So usually what happens is that the ACB is 70,000, right? And with that 70,000, you have $200,000 of cash value basically, right? If you take out 100,000, it's half of the cash value. What you can do is your ACB is going to be half as well. So by the percentage of money that I'm taking out of my cash value, I deduct my ACB as well. So that's how it's going to look like. Because it's 50% of my cash value, then it kind of looks like out of that $100,000 that I want to take out, let me just erase this part. So from the $100,000 that I want to cash out, I'm kind of looking at it this way. That $30,000 of it was ACB and $70,000 of it was gain. All right. So I pay tax on this $70,000. Again, it's a universal life. I'll get 50% tax exempt. So I'll pay tax on $35,000. All right. And then my new ACB for my policy, because I still have my policy and there's still going to be $100,000 in it. My new ACB is also going to be $35,000. Sorry. Oh, this was 35. My bad. No, this is 65. Anyway, doesn't really matter. So that is how you do it. All right. If it's a partial surrender, you kind of look at the portion, and based on that, you will reduce your ACB as well. So a part of that money that you're taking out, a part of it is your ACB, and a part of it is your growth. All right. Let's do a quick review, and then we're going to end this session. And then there's going to be a last part to it as well. So which ones are permanent? Obviously, T100, whole life, and universal life are permanent policies, but a term insurance is not. Which ones have a cash value inside it? It's whole life and universal life. Which ones have a modal factor? Whole life, term, and term 100 all have a modal factor. Which ones are customizable? It's a universal life. Which ones can you make changes down the road? Again, it's a universal life. Which ones will give you additional benefits? Obviously, it's universal life, whole life, but there are some other benefits we're going to talk about that we can also add to term 100 and term insurance. In terms of price, a universal life is more expensive than a whole life, and it's more expensive than a T100 and a term insurance. And again, a convertible policy is more expensive than all of these. So keep that in mind. Let's look into some questions, and then we're going to go to the next part. So this question is saying that for which of the following individuals a UL policy is preferred? UL policy, remember this. First of all, if it is somebody with variable income, you always choose universal life. All right. So in this case, as you can see, Hadley or Haley has a variable income. All right. So this is going to be the answer. But let's check the other choices as well. So for Ruby, she's not financially disciplined. If she can have access to her savings, she will use them. So you have access to universal life savings after a while, right? So it's not basically the best option. Option B is somebody that's easily overwhelmed with more complex products. Universal life is considered complex because of the investment part of it, because of the mutual funds, and always prefers simple and guaranteed products. So as we mentioned, a universal life, it's not guaranteed in terms of the investment portion. And if your investments don't give a good return, you might need to pay more premiums to cover the cost of insurance in the future. So even the premiums are not guaranteed, right? And the third one is somebody that earns above average, has stable income, but is risk averse. So they obviously don't want to take any risks. In purchasing a universal life, investing in mutual funds is a risky investment, right? It might be a low risk, it might be a high risk, but eventually there's some risks in mutual funds. Therefore, it is not suitable for somebody that is risk averse. So if somebody is looking for a guaranteed product, somebody is risk averse, somebody prefers simple products, not complex ones, somebody that could usually, has no, control over their um, spending, a universal life is not a good product. But for somebody that has a variable income, because of the minimum maximum funding that we can do and we can make changes, obviously a universal life is a good option. Let's go to another question. So Severio has been a professor at the University of London for over 2 decades. So he has a modest life, and he always had enough extra funds to enjoy vacations with his wife, provide a good education for his children, and indulge in a few luxuries for himself. So he decided that he would like to leave a legacy of $150,000 to the university. After talking with his insurance advisor, he decided to purchase a universal life insurance. So the decision has been made that it's a universal life. Obviously, by the looks of it, I would say there's no need because doesn't want the cash value, doesn't need the cash value investment. Already has been a professor for 20 years, so probably, his age is a little bit um, more in the uh, maybe late 50s or something like that. And so it's going to be more expensive. Plus, that's really not the right decision to give a universal life, but eventually they want to give a universal life. So first of all, let's just focus on that they're going to get a universal life. So which of the following features would be the most affordable method to help meet his objectives? So does he need a level death benefit or an index death benefit? He wants to leave $150,000 to the university. And nowhere in the question it's telling me that if he lives 10 years more, he wants to leave more money, right? It just says that whenever he wants to die, he wants to give $150,000. So he doesn't need an index death benefit that's going to increase every year. He needs a level death benefit. Now, between yearly renewable term insurance, right, the YRT cost of insurance, or the level cost of insurance, which one would be a better option? I would say it's going to be a level cost of insurance because he's a little bit older right now. He doesn't want the investment part. So we do that YRT when we want to grow our investments in the beginning years, right? Because I'm investing more, I'm putting more money of my premium inside the mutual funds. But for him, it's not important. And his age is a little bit older as well. So what we want is more steadiness. And that steadiness is going to take us to choosing a level cost of insurance. That is how we get the answer. Let's go for another question. Andrew's participating life insurance, so he has a whole life policy, was issued on April 26, 1998. Since then, he has paid $28,000 in premiums and received $4,000 in cash from policy dividends. The cumulative net cost of pure insurance, the NCPI, which again means cost of insurance, is $11,000 and the cash surrender value is $50,000. Marginal tax rate is 45%. How much tax will he pay? All right. So if we want to understand how much tax he will pay, um, um, we have to first see how much he paid inside it, and then we can deduct it from that $50,000. So $28,000 is a premium, $11,000 is the cost of insurance. So I will do $28,000 minus $11,000, right? And that would give me $17,000. This is my ACB, right? Premium minus cost of insurance. Now, Andrew has $50,000 cash value, but remember that he also took and basically received $4,000 in dividends as well. So the sum of this is actually $54,000, right? That's how much he made, a $50,000 cash value and $4,000 dividends. So he has to pay tax on all of that, minus the ACB, which is $17,000. That would give us how much? Basically, let me just take my calculator out. So 54 minus 17, that would be $37,000. This is the growth, right? So now he has to pay tax 45% on this. So $37,000 multiply 45% is going to be how much? It's going to be 16,650. So option C is the correct option. This is how we calculate it. So we added whatever gain that he made, basically the cash value of the dividend. We deducted the ACB out of that. And then because it was a whole life policy, there was no 50% tax exempt. So we just immediately multiplied it by the tax rate. All right, and that is how we got to the answer of 16,650. All right, so we're going to have a break here, and then we're going to go into the next topic.